Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview, and today, global market update right here from the heart of the financial district in central London. I'm Martin Bakkerdax. I am the London Bureau Chief here at TheStreet.com, and I'm going to take you through those 5 things you need to know before the bell. Now, I say global today because we are looking at a global phenomena in equity markets and indeed financial markets because of the rising political tensions in the Asia region. I'll talk about that in a moment, but let's get a state of play as to where we are in European bourses, because we're seeing steep declines across the board today, particularly in Switzerland because of the rising Swiss franc, but we're also seeing significant declines across the board around the rest of the European markets, down 1.2% in Germany. Similar percentage declines in France and Italy as well. We're getting a little bit of support on the FTSE 100 from gold miners, but nonetheless, the benchmark here is down about 0.6%. So collectively, we're looking at one of the biggest declines in a couple of weeks, and in the Swiss case, even a little bit more than that. Now, what we're seeing, of course, as you might imagine, are safe haven flows. Curiously, those safe haven flows are not necessarily driving into the US dollar as they typically do. I'm going to pull up a gold price right now because that's a traditional safe haven play. Gold is up about $6 to $7 an ounce at 1,267. The Swiss franc, however, is up a little bit more than 1% against the European single currency. So investors seem to be preferring that destination to some others, and that's a big part of the reason that the Swiss stocks are down, because most of the benchmark earns its revenues in US or euro denominated currencies. And we saw a similar dynamic in Asia, where the yen gained significantly against the US dollar, and that held down gains and actually pushed the Nikkei 225 into a 1.3% decline. So whilst treasuries did get a better bid, they were about 3 basis points tighter at the 10-year space to about 224. We're not seeing direct flows into the dollar index and as an adjunct into the US dollar. Investors seem to be preferring other assets, and I do think that's an interesting dynamic indeed. But nonetheless, we're looking at deep red across the board, and we're pulling Wall Street futures lower as we speak. Now, how did this all begin? We got to go all the way back to July and the testing of an intercontinental ballistic missile by North Korea in and around the region that ignited a significant political response from leaders not only in Japan and China, but of course from the United States as well. As a result, the UN Security Council passed sanctions against North Korea only at the weekend. They did it by a vote of 15-0, and it was a legitimate political victory for President Donald Trump, who's been pushing for this for a long time, as of course have prior presidents who have been sitting in the White House because they have been flummoxed by the recalcitrant administration in North Korea and, of course, the reticence of neighbors in the region to act with any great decisiveness. So as a result, we had those sanctions, and therefore we had an even faster escalation of the atomic weapons program in North Korea. Now, according to U.S. intelligence officials that were ultimately, I would say, confirmed, but certainly buttressed by comments from Japan, we saw or heard evidence that North Korea has the capability of putting an atomic warhead into a missile that it says could at least reach Guam, a U.S. military installation in the South Pacific. Now, North Korea has said it is going to carefully examine a missile strike against Guam, and this elicited a response from President Donald Trump, who said that any escalation of the current situation would be met by fire and fury. He said this whilst at one of his golf resorts in Bedminster, New Jersey. Now, what's interesting on a whole number of levels is the fact that the president appears to have drawn a red line, something that he said he would not do in and amongst the discussions that he's had about the tensions in the region. He's also doing this, it seems, in absence of his Secretary of State. Rex Tillerson is actually in the region as we speak, and it doesn't appear, at least on face, that there's been a great deal of communication between the two gentlemen prior to this statement being made. We don't know whether the president has made the statement off the cuff or as a result of consultations with generals at the Pentagon. The Pentagon issued a statement that was a little bit bland with respect to the details about the timing of the president's thoughts, but nonetheless reiterated an expectation of a full and robust defense of U.S. installations, of course, anywhere around the world, and that's probably not surprising. Broader questions about this, of course, remain whether U.S. lawmakers want to go along with the president and whether or not they feel his drawing of this red line is an acceptable tactic in a situation that is so sensitive and involving nuclear weapons. Whether or not regional allies are going to want to go along with the president, particularly when he's pressing them on other issues with respect to trade and commerce. And of course, he's been using trade and commerce as a carrot against the stick of their recalcitrance for the political dimension in the region. And then, of course, perhaps ultimately, and hopefully pushing away some of the concerns that we have from a military point of view, as to whether or not these tensions are going to cloud the domestic agenda of the president, which is getting thicker by the day as we approach a debt ceiling deadline, as we try to get budget negotiations through, and as, of course, as the administration continues to plow through with its efforts to reform healthcare and the tax code. So these things certainly can't be seen in isolation, and that is certainly part of the reason why we're seeing such significant declines for global equities, even though it has to be caveated, have been trading at near all-time highs on a world level, and certainly multi-week and multi-month highs here with respect to Europe. We're going to move on to some individual stocks in the United States today. Disney is going to be a big story and has remained so overnight. Shares are trading about 3.4% lower in pre-market. They had a decent second quarter, not a great second quarter, but a decent second quarter in the sense that they met, for the most part, expectations of analysts on Wall Street, although revenues and earnings did decline, particularly in Disney's cable division, and that was as a result of higher programming costs at ESPN and falling ad sales. But really the story about Disney is this big shift that CEO Bob Iger is planning. He is going to pull some Disney content away from Netflix as of 2019. He's going to roll out the company's own online streaming service to go direct to customers, and he's going to do that after unleashing a similar streaming service for sports through the ESPN app. And of course, we know yesterday that CBS said it was going to do very much the same. So you can see now providers putting more and more effort into direct customer engagement as opposed to licensing their content to other providers, in this case, Netflix. But this is a big gamble. It's a calculated gamble, I guess I should say, for Disney, and the company has done these sorts of things before, but nonetheless, it's not going to come without cost. Now, part of the rollout to the streaming services is going to require BAMTech investment. They have to pay another $1.6 billion to get a 42% stake in BAMTech. They had already owned some already, but that is going to eat into earnings in the next couple of quarters as a result of the expenditure, because that is needed to create the technology that will allow a significant number of subscribers to do what they need to do with the new platform. There is also the anticipation that about $660 million in annual revenues is going to be lost from pulling the content away from Netflix. So certainly Disney is going to have to make up that shortfall somewhere in the analyst's mind, and at the moment they haven't really articulated precisely how that's going to happen, but it is early days, and it does suggest that there are some questions, even though the broader strategy seems to be the right one, exactly how investors and analysts will be able to recalibrate the price of the stock in the face of these big changes. And as we've talked about before, the sand is shifting underneath the media landscape day by day, and this is just another example of exactly that. Now, Netflix shares are also called significantly lower, 4.4% in fact, in pre-market trading, and they might open around the $170 per share mark. They, of course, are losing the Disney enterprise. They are going to not have the new content from 2019. They are going to have the Marvel-related content, which will remain on the platform, according to the two companies. But the Pixar and the traditional animated product from Disney will not be a part of the Netflix suite from 2019. Now, by some estimates, the Disney franchise gives Netflix around 30% of its U.S. viewership. Certainly everybody who has children in the house knows that these products are incredibly popular with the little ones who are running around the house, and they can, of course, watch these on Netflix to their heart's desire, and that's a big part of the reason that Netflix has grown its subscriber base and also has grown its viewership in minute-by-minute terms as well. It's interesting if we look back to Monday, when Netflix announced its first ever acquisition of a group called Millar World, which is responsible for the Kingsman and the Old Man Logan franchises in the sort of a comic book superhero realm. We sort of understand exactly why they were positioning themselves now after the fact, because whilst they are going to have Marvel from 2019 onward, that may not last forever, and it does seem that the company is moving towards producing some of its own content. But this is where it gets tricky. When you go from being a content provider to a content creator, you, of course, elicit all sorts of questions from investors and analysts as to whether or not you're going to be as valuable in the hit and miss world of Hollywood production as you would be simply in the streaming world, which is a lot more predictable in terms of cash flow generation. So you can see this being played out in the share prices, certainly right now. But Furthermore, with respect to Netflix, they are looking at a significant debt pile as a result of the borrowing they've had to do to buy the content that they currently have. Plus, they have a negative free cash flow proposition at the end of last quarter of about 2.1 billion US dollars. They're going to have to pay about 13 billion in licensing fees over the next 3 years in order to keep the content that they have already promised. And of course, we know that not only Disney and not only CBS, but Amazon as well is starting to eat away at some of their market share by offering platforms that are similar in nature to Netflix. Netflix is growing its U.S. subscriber base, its non-U.S. subscriber base very, very quickly indeed, and they may be able to make up some of the U.S. shortfall as a result of that. But certainly investors are again doing a little bit of a reset on their valuation on Netflix as a result of the loss of a very key customer and their slight movement into that hit and miss world of content creation. All right, let's take a look at Wall Street because we are looking at significant anticipated declines. I want to bring them up in real time to make sure I'm giving you the exact figures. Actually, it is improving a little bit, it has to be said, and that's good news. 38 points to the downside for the Dow Jones Industrial Average is what we are seeing at the moment from U.S. futures prices. That equates to about a 0.2% loss. Now, it's a little bit steeper for the broader S&P 500. That's called down about 0.3% lower, and the NASDAQ is called down about 0.7% lower. So we are stabilizing a little bit, and again, that is good news. Oil prices have been drifting in and out of positive territory for much of the day, but I think investors are going to be looking for the Energy Information Administration's data on U.S. crude stockpiles a little bit later today in order to get a direction on prices. OPEC is trying to get together some compliance on the production cuts, and they've had 2 days of meetings in Abu Dhabi, haven't really come up with anything firm just as yet, and that's part of the reason the prices aren't moving with any great clarity, at least at the moment. Again, I remind you of this dollar influence that we're seeing in global markets and the fact that investment flows into safe haven assets don't seem to be including the greenback. I do think that's a telling dimension to what we're seeing in financial markets over the last 2 or 3 weeks and indeed the last 5 or 6 months. But what we are seeing is flows into gold, into the Swiss franc, and into the yen. Actually, I wouldn't say a retreat from the US dollar, but certainly not a race towards the greenback. Okay, that's it from us here in central London and 5 before the bell. Please be careful trading out there. We'll hope for the best in terms of these political developments in and around the Asia region, but at the moment we're called 43 points down on the Dow Jones Industrial Average and a little bit steeper on the other indices. Good luck today. This is it for 5 before the bell. We'll see you tomorrow.